With CPI, PPI, and the interest rate hike decision all within 7 days, the markets are preparing for a big move. In today's video, we're going to be reviewing the short-term time frame price action and as well discussing the impact these news events could have on the markets. Let's go ahead and jump in. Alright team, welcome back to the channel. I hope you're having a magnificent day today. We're here to take a look at Bitcoin on the small time frame and the higher time frame. Specifically focusing on the smaller time frame price action, discussing the next move for Bitcoin and the current consolidation range. We'll also focus on the upcoming news events being PPI, CPI, and FOMC, talking about the potential impact these will have on the macro direction and short-term price action. Before we get into it, smash the like button, hit the comment button, and subscribe to the channel. We do daily videos for Bitcoin, focusing on the facts, the data, the technical and structural information, and so much more. No hype, no emotion, no BS, pure raw TA. If that is the kind of content you like and are interested in, join us on Telegram for more of it. It'll be the second link down below. You've got access to charts, updates, analysis, videos, educational posts, news events, and everything in between to keep you in the loop with Bitcoin's price action and the broader economy. If you're interested in joining our VIP channel, where we post exact trading signals of exact entries, targets, stop losses, and more. This one was posted literally like, 2 hours ago. We can see over here, entries, targets, stop losses. Nice 50% profit on there, guys. This is a channel to be in. Along with our exclusive trading signals, you'll get access to our group chat with a variety of different group chats of all of our members in here, trading, learning, educating, and profiting. For more information on how to join, go to our free channel, guys. Click the pinned comments, scroll to the top, and you can find all the information, including how to contact me. Let's go ahead and jump into the market. So Bitcoin for the month is currently down 3.14%. Again, we're pushing 9 days into June, so this is getting quite interesting. 9 days into June, we are still in the red. It'll be very interesting to see how the rest of the month plays out. If we do look at that monthly chart, which we'll bring up over here, we can see on the monthly chart, we did very much, in fact, print a bearish candle. This was very much a bearish candle. We can see it was a bearish engulfing candle representing a closing price below the prior candle's opening price, and the prior candle being April and this candle being the candle of May. This also represents a shift in strength as well as momentum and potential direction, as we did see this bearish engulfing candle occur after numerous large body candles on that monthly chart. Again, these are all green candles, 4 in a row, followed by a bearish engulfing candle representing within this monthly period there was a significant shift in momentum toward the downside, volume, liquidity, and volatility, all potentially representing a reversal. In this month, we have now opened up this candle red and we are down 3.14%. Again, very interesting to see how this develops, as we do not quite yet have a bullish macro monthly uptrend. For a bullish macro monthly uptrend to begin, we need to close a monthly candle above 30,000. Maybe we'll come back and discuss that in today's video. Moving on, guys, looking at our volatility index, as expected, we did see our volatility index spike upwards. With that move upwards on the volatility index, we did see a lot of volatility in Bitcoin, being this period of price action here. As we've been telling you guys for the last few days, when volatility spikes upwards, it's a good indication the price action is going to be more sporadic, volumes increasing, liquidations increasing. That is exactly what we saw. In fact, 2 days ago, we saw over $300 million in liquidations in a single day. Currently, if we look at liquidation data, we can see 45 million in liquidations, down 56% in the last 24 hours, and volume is down 37% to 52 million. As for the liquidations, we have a pretty even split, around 60 to 70% of those being long still, and the remaining amount being short. So longs are still feeling the pressure, although overall liquidations are dropping as the price enters this sideways consolidation. We'll discuss this sideways consolidation in our short-term analysis today. Let's go ahead and talk about the broader markets, the DXY, the economic data, the impact that's going to have on crypto and the broader markets, and then we'll go ahead and jump into our short-term analysis. So the DXY has seen a decent pullback in the last 24 hours, but as I've been saying, really nothing too much to really pay attention to. The DXY is not really something we're looking at on a daily basis. We're looking at on the weekly, we're looking at the higher time frame trend rather than the intraday movements or the day-to-day movements between open and closed prices. What areas of concern we are looking at are two things. The current daily uptrend represented by this black trend line with the cross over here, the arrow. This represents the uptrend, meaning regardless of what happens between here in that trend, we are still technically in a uptrend until this level is lost. If this level is lost, that is when we have concern for the DXY. That is when we now expect the DXY to flip and head back towards these support levels. Until then, if it is able to hold above this uptrending support, an inevitable breakout of this downtrending dotted trend line will occur, resulting in a move into this next liquidity zone sitting at 106 to 105. So for now, the DXY is still bullish on the daily chart. Although we've had a pullback in the last 24 hours, it is still very much in a uptrend, and it is safe to assume the uptrend will continue until the uptrend support line has been lost. Now, as you know, we have CPI coming out, we have PPI coming out, and we have the interest rate hike decision coming out. Every single one of these events is going to massively impact the direction of DXY. CPI and PPI being leading. PPI is leading for CPI, CPI is leading for interest rates. Interest rates directly impact the risk in the market, and the risk in the market determines the direction as it determines the cost of debt. So we'll be discussing that in a little bit more detail in just a moment. We'll come back to it. Looking at the Dow Jones and S&P 500, we can see the S&P 500 has broken a daily above our horizontal resistance. Incredibly good to see a very bullish move for the S&P 500. Again, we do have our upper resistance at around 4,500 as per our rising channel formation. That is a realistic target for the S&P 500. And should be assumed, again, we are in a uptrend until proven not. The uptrending support line is this uptrending support line represented by this black trend line over here. When do we flip bearish on the S&P 500? Well, if this trend line is lost, that is when we look for a weekly correction. A weekly downtrend will resume, will begin if this uptrend is lost. If the price is able to lose this level, we expect the price to move downwards all the way back to 3.6. If we do see the price climb upwards, we do want to see a weekly candle close above this resistance level to validate a move up into this range. Even if we push up into this range, guys, we are still in a overall bearish pattern. This is a rising channel formation. So for the price to push any higher, we do need to structurally invalidate this bearish pattern. And considering the length of this pattern, it will require quite a fair bit to invalidate it. What will it require? Well, it will require CPI, PPI, and interest rates to actually signal the market risk is decreasing. We'll discuss that in a second. If we do see the market risk increasing, meaning interest rates will continue upwards, interest rates are not going to pivot, it is very unlikely we can see the S&P 500 actually invalidate the structure. It is more likely we see a move toward the downside. The same goes for the Dow Jones, guys. We do have our horizontal resistance right over here. A break of this level is going to be absolutely necessary for the price to push higher. On the weekly chart, we are now apexing between our horizontal and our uptrend. A weekly candle close above or below will determine the directional move. So before we get into Bitcoin, let's discuss the news events, and let's discuss the impact these news events will have on price action. Now, a lot of people probably think this is boring stuff. A lot of people probably not too interested in it. But if you're going to trade, guys, especially if you're going to trade the macro charts and higher time frame directions, and you want to learn how to apply biases to directions and trends, you need to understand, at least from a basic level, how this stuff works. And this is what we do here. We're going to teach you from a basics level. As you know, I've got a background in economics, so we can go into a lot more detail, but I'd like to keep it nice and simple for everyone to understand. So, really quickly, we'll talk about this flowchart. This is a flowchart I mentioned very briefly. We have CPI and PPI as leading data. CPI represents inflation, PPI represents inflation for producers. So producer price index, the cost of materials and production costs, and those production costs generally get pushed down to consumers. So if a company that's producing something that you buy has to now spend more money to produce that thing, generally they want to keep the same profit margin, so then they increase the price of that good or service to you, and you have to pay the increase, and therefore inflation rises. So PPI is a leading indicator for rising inflation, as the difference in change of that production cost generally gets pushed down to you as a consumer. So we are looking at PPI data coming out. pretty soon. In fact, PPI data will be coming out on the 14th. We did see the previous month at 0.2. The consensus and forecast is around 0.2 and 0.1. Therefore, this represents a increase overall in PPI month on month, because we are plussing 0.2 and plussing 0.1. But what it represents is it represents a decrease in month-to-month change. And this is very important to understand, because since the markets moved on perceived systematic risk, which I'll get into a second, the month-to-month change creating a potential future trajectory of the trend is more important than the data itself. So if we see a shift downwards, that trajectory or that curvature moving downwards is what the market is going to perceive in terms of overall market risk, and the market will react on a higher time frame to whatever that perceived trajectory is going to be. So along with that, we'll get into that in a bit more actually when we show you an example. But along with that, we have CPI coming out. As you can see, CPI, the prior was 0.4, so we actually saw inflation month on month rise last month, and we saw PPI rise last month. So the two indicators there, the leading indicators of inflation, suggesting inflation is actually going back upwards, which is very scary stuff. In this month over here, we can see the consensus is 0.3 and forecast is 0.3. Therefore, for both of these, any result higher than the prior month is going to be incredibly bearish. Any result lower than the forecast is going to be incredibly bullish, and any result between previous and forecast is going to be more neutral and will be pushed down to what the interest rates do to determine the direction of the price action. Okay, so let's move back to this chart over here. You can see this determines inflation. Inflation directly determines interest rates, because interest rates are lifted and adjusted based on inflation, and we'll show you this upper chart in a second to explain that. As you can see, if interest rates change, the dollar, it impacts the dollar, it impacts the costs of goods and services, it impacts people's debt ratios. So for example, if interest rates go up, okay, we see the dollar increase in value, okay, we see debt to service ratios increase in value. If that happens, people's available household cash flow decreases, have less money to spend on goods and services, as goods and services also rise to account for the rising inflation, and the rising inflation again is the trigger for interest rates to rise. So in this instance, we have a situation where people are now actually saving less, spending more, and they have less available cash flow. If we look at the data on income for households in the last month, we can see all of that is actually suggesting they actually have less money available. They're spending more money for these essential services. But if we look at retail sales are dropping, meaning people actually have less money to spend on discretionary things, and they have more money, or they have to allocate more of their money to servicing their debt, as interest rates are still on the rise. If we see all of this happen, companies generally sell their assets to increase their cash flows. And again, retail is less likely to invest in risk assets, again, dropping asset prices potentially further. So you're probably wondering, well, if interest rates have been rising, why do we see the markets rally? Why do we see Bitcoin rally? Why do we see the S&P 500 rally? Why do we also see that rally? Well, it's very simple. Like I said before, the markets moved on perceived risk. They move on the trajectory of risk, not the risk itself. So what we saw was inflation was rising month on month for a very long time. Okay, then we saw inflation peak. Perfect. Now, we know interest rates are lagging to inflation, meaning interest rates will only go up if inflation goes up. Therefore, they're always going to be a step behind what inflation is doing. So that they ended up going up. Then inflation was falling for a few months. This is around, now we're looking around late last year, moving into January, moving into February, we saw inflation was falling, moving into March, inflation falling, and therefore interest rate, the month-on-month change of interest rates were dropping. Although we're still rising interest rates, the month-on-month change went from 0.75 down to 0.5, down to 0.25, and that represents this drop in trajectory, the trajectory of the future interest rate hikes. That is what we're looking at. That formed a perception in the market that future systematic risk was falling. It created this overall trajectory in interest rates that eventually would end up leading to a pivot. That formulated trajectory, based on what interest rates and inflation were doing, resulted in a risk environment that facilitated asset growth. And that is why we saw asset prices rise. Remember, price action isn't random. Price action is derived from economic decision, political decision, and social perspective. We saw social perspective impact Bitcoin positively when the banks were failing. We see political decisions impact the rate of change for economic data, how quickly they adjust things, laws and regulations that could impact assets, and more importantly, economic data, in fact, directly impacts the overall perceived risk. The market risk and market perceived risk are two things. Markets move on perceived systematic risk. The economy is represented by actual risk. Very important stuff. So what we're seeing now is inflation is rising. We saw all of our data suggesting inflation is moving back up. Now, if this continues into this month, meaning if we get data suggesting inflation is back on the rise this month, that could actually trigger interest rates moving back up. And that could trigger a second wave of interest rates, or at least an extended continuation of interest rates that would delete this trajectory. If this trajectory or narrative gets removed, the price action adjusts according to the future perceived systematic risk, and we go back into this cycle over here and asset prices fall. That's all that we're going to talk about today, guys. I can go over one more chart, which is up over here, but we're not going to go ahead and get into that today because we are running out of time and I don't want to spend too much time on that. Let's go ahead and discuss Bitcoin. I wanted to briefly interrupt today's video to discuss my favorite exchange, Bitget. If you're looking for a safe, honest, reliable, and accurate exchange, look no further than Bitget. You can sign up by the link in the description to support the channel and get access to 3 exclusive perks. That being up to $5,005 in trading rewards, up to 15% discount on your trading fees, and exclusive access to our MegaWhale promotion campaigns that we run every few months. Alongside that, guys, Bitget is a non-KYC exchange, meaning you do not have to KYC. It is completely optional. Bitget also has a protection fund that secures user assets against external hacks and threats in the space. Alongside that, guys, Bitget offers up to 125x leverage on futures with extensive amount of trading pairs and liquidity on the market. I highly recommend signing up to Bitget. It is the exchange I've been using for over a year and a half now, including all of our members. If you're interested in signing up, trading there, and supporting the channel, you can do so with the link in the description. Thanks for listening. So, as you would know, we talked about the daily yesterday. We'll go really briefly over it and then we'll into the short term. Overall, daily downtrend very much intact. Okay, the daily downtrend is very much intact. The daily downtrend is intact while the price remains underneath the black trend line and while momentum remains in the negative. Okay, we have negative momentum. The point of which we have positive momentum is when the RSI breaks above here. That is a momentum shift. At the moment, we have daily downtrend, we have daily negative momentum, and therefore we're on a weak bearish trend. The weekly chart, however, is technically hanging on by a thread. If you look at the weekly chart, we're just above the 200 moving average, we're above the 50 EMA, and we are above the major horizontal support being the weekly uptrend support at 25.2 to 24.4K. That is our weekly support. You can notice the moment we actually broke above that level, that is when the weekly trend actually initiated. That is when we broke over the 200-day moving average, putting us into a weekly trend. So the daily downtrend, we have a weekly uptrend, and therefore we are in a weak bearish trend, as we do have a discrepancy between those two trends. So for the daily trend to flip bullish, we need to see the price action break above this downtrending resistance and the momentum needs to flip positive. Until then, the trend is down. There is no question asked, the daily trend is down. While the daily trend remains down, the bullish trend on the weekly is at threat of flipping bearish. If the price pushes below 24.4K, we flip bearish on the weekly chart, and that of course can result in a huge correction downwards to 20,000. Now, for the macro trend to flip bullish, we need to see a monthly close of 30,000. Before we even question this, we need to see the daily trend turn bullish again, right? Because before we even think about 30,000, we need to see $28,000 reclaimed. We need to see this downward trending resistance reclaimed. Hypothetically, if we do break over that level, the reason 30,000 is the key level to break above is because it represents the yearly low of resistance in prior cycles. If we take a look at the prior cycle, we had a base of support. When we lost that base of support, we crashed to the bottom. This cycle, we had a base of support. We lost that base of support, we crashed to the bottom. Prior cycle, we had a base of support. We lost the base of support, we crashed to the bottom. When does the market start to create this uptrend again? Well, we look at those bases of support. What we can do is we can say a monthly candle above that base of support results in a move towards our dotted trend line. Our dotted trend line being the first high of the dead cat bounce in the bear run, okay, in the bear market. And again over here, the dotted trend line. A break above that level on a monthly results in a move upwards. Furthermore, we can take a date range analysis and an angular analysis of the overall trend from 2 points. That being the trend angle from the bottom to the point at which we break the dotted trend line and the point at which we break the dotted trend line to the top. And we can do that for all scenarios. We can go back in time, we can do it over here, dotted trend line, and then from dotted trend line to top. What we see in both scenarios, if we zoom out, we can see that the overall trajectory of the trend in this scenario, if I zoom in again, in this scenario, the overall trajectory of the trend increases from 31% to 62%, and therefore we go into a bull run when we break over the dotted trend line. In this instance, that would be 48,000, okay? But we go into a macro uptrend when we break over the solid trend line. That is the same for that prior instance, which again, we can show you over here, okay? The velocity increases, and therefore the angular momentum of the price action will increase in steepness as well. 24% bottom to dotted trend line, 55% to top, representing a shift in volatility, a shift in volume, and a shift in liquidity past the dotted trend line. Let's go ahead, guys, and talk about the short-term price action. As you can see, we have our short-term range. We'll bring these indicators down for just a moment. The short-term range is very much still intact. If we zoom out, we do need to see a break of this range for the price to determine the direction. And again, a lot of this determination of directional action is going to be determined based on CPI, PPI, and interest rates. Interest rates are going to shift the markets. If the interest rates come out negative, meaning they come out bullish, they go down, we go 0.25, we're likely to go down to a pivot, the markets will rally. They are going to rally. If the interest rates come out bearish, saying we need to extend interest rate hikes, we're going to go up to 0.5, we're going to hold 0.25 for many, many more months with no sight of a pivot, the markets are going to crash. Okay, now, how can we use this chart to help us? We look at our key levels. Key level number 1 is going to be downward sloping resistance as per this downtrending trend line. That is going to be a daily down sloping resistance. We can see a break above that level puts us into a daily bullish trend, and therefore the weekly bullish trend continues. At the low side, we can see a loss of 25,800, 20,600 will put us into a strong bearish trend, and therefore a weekly bearish trend. Remember, the 200-day moving average on the weekly, the 50 EMA is going to be lost if we lose 26 to 25.8. So those are our two high levels. We have a high level, we have a low level. Perfect. Okay, now we go down to our ranges. So we have a horizontal consolidation going on the chart over here. Perfect. We have the distance between the upper range and that trigger point, and with the distance between the lower range and that trigger point. If we lose 26.3k, we go from range bearish being bearish in the current horizontal range, to overall short-term bearish, which is going to be bearish from the breakdown towards 25.8. If we break above 27.4, we go from range bullish, meaning the distance between the POC, which is this red line, upwards, range bullish, into bullish on the short term, which is the distance between 27.45 to 28,000. Thus, if we break above 27.45, expect a continuation of 28,000. If we lose 26.3k, expect a continuation down to 25.8 to 26,000. In the middle zone, we have a zone of strong price action and weak price action. The separation of that is determined by the POC. Anything above the POC, from POC to the range high, is considered strength. Anything below the POC to the range low is considered weakness. So right now we have overall weakness. Furthermore, a continuation from range high downwards puts us into a range bearish trend. A continuation from the range low upwards pushes us into a range bullish trend. And therefore we are in a range bearish trend with overall weakness, as we are underneath the POC and we have moved toward and below the POC and range low from the range high. Expect the trend to continue downwards if 26.3k is lost, but as you know now, support is supporting to us not, and therefore 26.3 is going to act as a potential bouncing point, which we have actually seen already it has. So let's go down to an even smaller time frame and bring up some technical indicators and discuss what is happening. So here is the short-term time frame. Here are the technical indicators we use. We use the MACD and the momentum, Marks OB and RSI. What we can see over here, guys, is we had a uptrending support. Perfect. This is a nice clear uptrend. We can actually use the RSI to validate this uptrend. We'll go ahead and do so in just a moment. Let's go ahead to a 30-minute chart to do that. what we can see is we have our points over here, we have our retest, perfect, there is our uptrend on our RSI, there is our uptrend on the price action. You can see the RSI broke down, meaning a negative momentum shift happened at this point over here, representing the probability of continuation was lower and the target being 26.3k. If you use momentum, if you traded momentum, you would have caught that short. Congratulations. Moving forward from there, guys, we can see if we went back on a smaller time frame. Since we have lost that level now is going to be acting as a resistance. This prior support is now going to be acting as a resistance, and therefore we do expect a continuation downwards on a smaller time frame unless the price is able to get back above that resistance. Furthermore, if we go ahead and draw a trend line across right over here, we can take these local high points. Okay, so we have high point number 1, the first point of the bearish divergence. Remember, when we take bearish divergences, we take that first point over here, not the second point. Then we draw it across to this high over here, and we can see we have another high over here represented by these rejection points. And therefore, we expect the price to move towards that lower support unless the price is able to push above 26.65. If we're able to push above 26.65, expect a move on the short term back to retest the POC. The POC sitting between 26.8 to 27,000, guys. I hope you enjoyed today's video. That is about it. I'm going to catch you guys in the next one. Peace out.